What if your kids never get to own a home, and the plan to make that happen is already in motion? That's not a headline. It's the quiet shift happening behind the scenes while most people argue about mortgage rates on social media. In the background, deep-pocketed institutions are buying whole blocks, whole developments, even whole towns. And while everyone's waiting for a perfect moment to buy, the rules of ownership are being rewritten. This isn't just a warning, it's a fork in the road. Stay a renter for life, or find the cracks in the system and slip through while you still can. But that's not the whole story, because the same conditions that lock families out can create the sharpest discounts we've seen in years. The kind of once-in-a-cycle mispricing that turns panic into profit for anyone prepared. Some say prime postcodes have fallen harder than anyone expected. Others say that's only the first domino. The questions are simple. Who's actually buying? Why now? And what does it mean for the last generation that might still own where they live? Keep watching, because by the end, you'll see exactly how the board is being set up and how to stop playing the game as a pawn. Prices don't fall evenly, they fracture. One street gets hammered, the next one holds. That's why most people miss the turn. They look at national averages and think, not in my area. Meanwhile, the data from certain pockets reads like a plot twist. Luxury districts wobble. Trophy postcodes blink. Properties that felt untouchable suddenly sit on the market with asking prices that would have sounded impossible 2 years ago. Sellers who laughed at low offers now take phone calls they wouldn't return last spring. And when fear shows up, narratives multiply. The headlines say, soft landing. The agents say, motivated sellers. The institutions say nothing and keep wiring money. That silence is the loudest signal. Because seasoned buyers don't react to the noise. They react to the gap between what something is worth in 10 years and what the current owner can stomach today. If you hear whispers that elite streets have shaved 30%, 40%, even more in isolated cases, that's not the market breaking, that's the market blinking. But who has the confidence to move when everyone else is frozen? That leads to the part almost nobody likes to admit. While families refresh mortgage calculators, funds and insurers are signing bulk deals. Not one flat, not two, entire phases of new builds, entire sites. It's the rise of build-to-rent, purpose-built units financed by institutions, designed not to sell but to hold, for decades. No chain, no mortgage drama, no subject to valuation. Just long-term capital flowing into an asset class that historically pays out in time and tax efficiency. It isn't just global names. It's domestic lenders, insurers, pension giants with brand names you've known your entire life. They aren't just offering products, they're becoming landlords at scale. And the logic is ruthless. If they can own the stock, they can own the income. If they can own the sites, they can shape the market. For the average buyer, that means bidding against balance sheets that don't flinch when rates wobble. For renters, it means a new reality. Professionally managed buildings on professional terms. Stability on paper. Dependency in practice. The play is simple. If demand outstrips supply for years, owning the assets becomes a pension. If supply lags, rents rise. If rates fall later, the equity pops. And if rates stay sticky, they wait. That's the patience retail buyers usually can't afford. So while households debate whether now is the bottom, institutions quietly remove the bottom altogether. And that introduces the pressure you can feel, but can't always name. Affordability has a way of feeling personal, even when it's structural. You don't need a spreadsheet to know rents are eating a bigger bite of each payslip. You don't need a governor to tell you a two-income mortgage is the new normal. What used to be comfortable on one salary now barely coasts on two. The weekly shop creeps up. Childcare costs step in, where a second parent used to be home. The household budget starts to look like a balloon you're squeezing from both ends. The middle bulges, something's about to pop. Now, layer in the multiplier. House prices versus average earnings. A generation ago, buying meant 3 or 4 times your salary. In many areas today, it's double, triple that, without the pay rising to match. Lenders respond by favouring joint applications. 2 incomes, 2 sets of payslips. Two people working longer hours to qualify. It's sold as inclusive underwriting. It feels like the new toll to cross the bridge. And here's the sticking point. If the base cost of a secure life is rising faster than the pay that funds it, something has to give. Time at home, savings for the future, or the dream of ownership itself. That's not a vibe, that's arithmetic. But the story isn't just about what families are losing, it's about what the big money already understands. Ask anyone who retired comfortably in the last decade where their wealth came from, and you'll hear the same answer more often than not. The house, not a tech startup, not a crypto punt. The home they bought 30 years ago and paid off slowly. The second property they rented out for a bit of extra income. The equity that swelled while life carried on. That's why institutions love residential real estate. It's a cash flow you can see, backed by a human need that doesn't go out of style. Insurers, pension funds, asset managers, they understand the quiet compounding of roofs and walls. Day 1, a rental can look modest. Year 5, rents are up. Year 10, debt has been chipped away. Year 15, the leverage ratio flips and the cash flow thickens. It's dull, which is exactly why it works. It doesn't rely on a viral moment or a moonshot exit. It relies on what people do every month, pay to live somewhere. So when you see headlines about billions funneled into residential platforms, don't read it as a corporate fad. Read it as a statement of intent. They're not betting on housing because it's cute. They're betting on it because they can model the next decade and they like the math. Which brings us to the paradox. The very forces locking people out can also unlock the best buying windows for the few who recognize them. So when you see headlines about billions funneled into residential platforms, don't read it as a corporate fad. Read it as a statement of intent. They're not betting on housing because it's cute. They're betting on it because they can model the next decade and they like the math. Which brings us to the paradox. The very forces locking people out can also unlock the best buying windows for the few who recognize them. Here's the uncomfortable bit. You won't catch the exact bottom. Nobody does. You only catch value. Properties you'd be happy to own for 15 years at prices that already look low against their rental income and replacement cost. And value tends to hide where people are most emotional. Luxury zones that felt invincible. Secondary markets with ugly headlines, regions starved of new construction. The places where the story is loudest and the math quietly works. And if you still think this is just theory, remember what happened the last time fear seized the market. In the last big downturn, prices didn't politely shave off 10% and stop. They overshot, banks retrenched, sellers handed back keys. The brave looked reckless. The cautious looked wise. Then time passed. The reckless entries became the best trades of a lifetime. Properties bought at 70 turned into 200. Not overnight, not with a magic trick, with patience, rental income, and debt that got smaller relative to everything else. Recessions don't make most people rich. They scare most people to the sidelines. But they do compress future returns for those who act while everyone else freezes. The logic is brutal and simple. When assets reprice fast, the next decade's compounding comes to you in a lump. If you can stomach buying when the neighbours won't, you're getting paid for the discomfort. This isn't risk-free. Over-leverage is how good bets go bad. A thin buffer is how a smart buy becomes a fire sale. The lesson isn't buy anything. The lesson is buy right. Cash flow first. Conservative stress tests. Fix what you can control. Financing, tenant quality, maintenance discipline. Do that, and the cycle becomes your partner rather than your enemy. And once you grasp why conservative buying wins, you finally understand why the banks behave the way they do. Ask for a large loan to speculate on a coin and see how fast the answer is no. Ask for the same money secured against bricks and mortar, and the conversation changes. That's because banks understand one thing better than anyone. Homes don't vanish. People don't stop needing shelter. If a borrower falters, there's an asset to take back. It's harsh, but it's also why mortgages exist at scale while other loans get rationed. So lenders structure their world to win no matter the cycle. In good times, they collect interest. In bad times, they take back assets that others can't afford to keep, then sell them later. Heads, they win. Tails, they still often find a way to win. Does that feel unfair? Maybe. But it's also a blueprint for how to stop playing the game as a customer and start playing it as an operator. Copy the parts that work for households. Buy assets that pay you to hold them. Lock in terms you can sleep with. Assume rainy years and plan to survive them. Don't rely on guesswork about rates. Rely on margins that function if the rate picture isn't perfect. The bank's edge is structure, not swagger. Build your version at your scale. Which brings us to the only decision that actually matters. 2 paths. On the first, you wait for clarity that never arrives. Rents keep climbing, deposits keep slipping out of reach, time keeps moving. You become a permanent customer of someone else's certainty. On the second, you accept the market's messiness and go hunting for value. Boring, cash-flowing, well-bought value. You aim for one property that holds its own, then another. You stop trying to time perfection and start stacking good decisions that compound. You don't need 10 units tomorrow. You need one soundbuy in the next window that opens. You don't need to outbid a fund online. You need to negotiate like a grown-up on a deal that fits your numbers. No heroics, no lottery ticket thinking. Just ownership that is slightly underpriced today and powerfully inevitable 10 years from now. This isn't a promise that everyone can or should buy immediately. It's a reminder that the window for ordinary people to own might not stay open forever. If institutions are turning homes into yield and governments can't build fast enough, then the last generation of owners will be the ones who stopped waiting for a memo and moved before the door clicked shut. And if you're still listening, you already know which one you want to be. The ground is shifting. Big players aren't arguing about whether housing is over or done. They're buying it. They're holding it. They're building portfolios designed to outlast tempers, headlines, and cycles. For families trying to buy a first place, that can feel like a wall. But for people who learn the rules, even late, it can be a ladder. You've seen what happens when fear takes over. Markets don't just correct, they convulse. Discounts appear when nobody expects them. Narratives scream while numbers whisper. If you've ever said, "I wish I'd bought back then," this is what back then looks like in real time. Messy, uncertain, argumentative, uncomfortable. It never feels like the right moment. It only looks obvious in hindsight. So don't wait for a perfect sign. Build a plan you can fund. Target areas where rent covers your sleep. Negotiate harder than you scroll. Focus on the type of property you'd hold for 15 years without flinching. Then act once the numbers fit your life, not someone else's spreadsheet. Because one of 2 things happens from here. Either the era of mass home ownership closes and the next generation grows up renting from badges and logos, or enough people slip through the cracks now to keep the flame alive. If you do nothing, the choice is made for you. If you move carefully, you give your future a fighting chance. Remember, in a world where institutions buy certainty, your edge is speed, sanity, and the willingness to own when the crowd is louder than the math. If you don't risk a measured step, you risk drifting forever. Choose your side before someone else chooses it for you. The next video breaks down the exact deal checklist I use to separate value from noise. Income, stress tests, financing traps, and the 5 red flags that turn a bargain into a bad buy. It's short, punchy, and worth your next 5 minutes. But first, breathe, then decide which path you're on.